maybe this is something that the government's introducing with intention. The fact that you're putting more of a squeeze on people that own investment properties will perhaps lead to more people selling properties and, a supply into the market around people being able to purchase property. But you couple that with the rate of interest that people are owning or that people are paying. And yes, rental prices have gotten significantly more expensive, but the cost of owning a property that you live in is still far outweighing the cost of renting a property.
Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics such as investing, cash flow, budgeting, saving, passive income, debt management, and much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Bills, here we are back again and back for another episode of the 360 Money Matters podcast.
Andrew, we are back again, and week in, week out, we are bringing some information and some entertainment, I'd say, to our listeners and our viewers on the 360 Money Matters podcast.
Yeah, my mum finds it really entertaining.
That's the one listener that we do have.
Exactly.
Andrew, let's rip straight into it. What are we talking to everybody about today?
Yeah, so look, a little bit earlier this year, there were some changes to land tax. And so we're going to talk about why it was introduced. We're going to talk about what the changes are and what's in store for property investors.
Okay, let's do it. So, because of our state government, I'm going to have a little bit of fun with this. You can see the smirk on my face here if you're watching along on YouTube. But basically, what it is because of the position that we found ourselves in, aka were put in by our politicians during COVID. Victoria has announced that from the 1st of January 2024 that they're installing what they're calling a COVID debt repayment plan that will apply to land tax. The idea is that there's increased land tax rates for a temporary period of 10 years.
Temporary.
We'll wait and see. Basically, just call it a budget repair levy or a budget repair tax. But once again, we're paying the price for it. We're paying the price for, I guess, an inept government and how they managed COVID. And I can say that with some authority because you look at Victoria's case versus other states and territories, and we suffered the harshest lockdown, and financially we're going to be paying the price for, in this instance, at least 10 years.
Yeah. And I think that's the key point in this. It's at least, because they say that it's a temporary measure, but I don't know, there's been very few instances. I can't think of any where the government has introduced a tax and then removed that tax. It only seems to go up and up. So yeah.
I mean, the truth is,
I'd love to be proven wrong in 10 years.
Yeah, no, I don't think you will be proven wrong, because the truth is, once you get used to, it's like an individual or a household, right? Like once you get used to a certain level of income, winding that back is very, very difficult. And, we're experiencing that now where we're seeing a decrease in the standard of living across Australia. People, you don't like doing that. So whether the government's going to be able to unwind this position after a promise of 10 years, we've seen recently that the federal Labor government have come out and broken a promise in relation to taxation. Refer to last week's podcast or the week before.
We're just ripping on state government, federal government. We're ripping on everyone.
Why would a Labor state government be any different?
Yeah. Well, there you go.
Anyway, enough of me beating up the politicians of the day. Andrew, let's talk around some details as to sort of what we're looking at here. Actually, even before we get into the numbers, let's talk about some of the impacts that it's having with, I guess, people that we're talking to and the implications associated with an increased tax on their investments, essentially.
Yeah, I mean, look, you talk about, and that's the kicker in all of this, it's an increased tax. So there's obviously, there's no benefit to anyone in this regard. But when you talk about people that own property or have an investment property, you consider the fact that you've had interest rate rises that have been very significant over the last 18 to 24 months. You're talking about inflation, you're talking about the cost of living, you're talking about the cost of doing any renovations on building supply costs as well as tradies, you're talking about the fact that there's now the checks that someone who owns a property or an investment property needs to perform on a property in relation to the gas, the electricity, all of that stuff. And ultimately that culminates into needing to spend more money in order to be able to retain an investment property. And there's a squeeze on property owners. I mean, we talk to, a vast majority of our clients own investment properties. It's a very common strategy around wealth creation. And now the costs on continuing to hold that property, it's becoming more and more difficult. And the ability to, snowball into the next one and do more is becoming more challenging.
So what I'm hearing is it's a failed government policy that's coming in at completely the wrong time when people are experiencing even more difficulty servicing, I guess, their properties at a point in time when we've got a rental crisis as well too.
Yeah, and look, maybe this is something that the government's introducing with intention. The fact that you're putting more of a squeeze on people that own investment properties will perhaps lead to more people selling properties and, a supply into the market around people being able to purchase property. But you couple that with the rate of interest that people are owning or that people are paying. And I mean, yes, rental prices have gotten significantly more expensive, but the cost of owning a property that you live in is still far outweighing the cost of renting a property. So I don't think that having a greater supply of properties into the market is really going to make any huge or significant impact.
Like I said, failed policy decision. But what is interesting, I promise we'll get into the numbers in a sec, but what is interesting is that, I don't know about you, but it just seems like the thing that the government the trigger that they have to pull when it comes to this stuff is just more tax.
Yeah.
It's just like, seriously, guys, come up with something a little bit more creative.
Well, come up with something that's not going to impact people quite as much. Maybe there needs to be some budget cuts that need to happen internally rather than some additional revenue that you need to generate from all of your taxpayers. That's my opinion. But nonetheless, there's ultimately not a huge amount that we can do about it. But it's impacting property owners. I mean, if you own an investment property, it's having a significant impact, and it's another reason why you're going to see investors that are going to need to make more money in rental income that they're receiving. And so there are stories, not stories. I mean, this is a scenario that we have with our clients in that it's come up to a lease renewal. And you're talking about increasing the rent on a property by $150 a week, which is massive, by the way. I mean, I don't think I've ever seen a property renewal where you're talking about $150 a week increase. I mean, you're talking about going from $400 to $550. And they're saying, look, I don't really want to do that to the tenants because that's difficult for them. And the fact that, I own an investment property and I can increase it to that, I don't necessarily want to. But I have to because of all of these other additional costs, and it's either me paying the burden or them paying the burden. I don't have the cash flow to do it.
Yeah, well, ultimately, I think what this does is this is the whole thing is what I was saying with tax, but it takes money out of people's pocket, right? Something that they could have been using to deploy in the economy elsewhere is being used up with a tax that's, we're not really, as in the people paying that tax aren't getting anything additional for it. No. This is trying to repair, like I said, and I said it jokingly and in jest, but to repair, poor policy decisions that were made back during COVID to try and stabilise the economy. And we could go into a completely different topic on this in terms of was it the right decision and was it not? Did we hand out too much government support? Who knows what that looks like? But ultimately, it's taking money out of people's pockets. And that flow-on effect because the property owner is passing that down at a point in time when the cost of living has, arguably never been its highest. And in terms of interest rates, yes, we've had higher interest rates, but not on the level of debt that we're carrying today as a society. Anyway, in saying that, Andrew, let's rip into some numbers to give everybody an idea of what this sort of looks like. So just to refresh, we're talking 10 years starting from the 1st of January 2024.
Yep. Then you're talking, so previously, if you had a property, now this is talking about land value. So
Yep.
land tax is only assessable on the land value, not the actual total value of the property. But if your land value previously to 2024 was less than $300,000, you paid no land tax. So that was kind of the amount whereby you're looking at, some apartments, you're looking at some smaller properties or outer areas that in essence weren't impacted at all by land tax. But now, when you're owning a property from $50,000 worth of land value to $100,000, which I'd argue that there's probably very few properties, particularly in metropolitan Victoria, that are falling within that.
Every property.
It's impacting basically every property now. So from $50,000 to $100,000, you're paying a flat $500 land tax. From $100,000 to $300,000, you're paying a $975 flat surcharge. And then from $300,000 upwards, you're paying a $975 surcharge plus an additional 0.1% on what you were previously paying as well.
Yeah, okay. So there's some pretty significant numbers. Let's just do it.
I think the easiest way to do it is, do some examples.
Let's just do a deeper dive on that. So if I've got a property that has a land component worth $99,000, I'll pay a flat $500.
Correct.
Right? If I've got a property that's worth where the land value is worth $101,000, that almost doubles and goes to $975.
Yeah.
And then if it's over, the land value is over $300,000, it's $975 as a flat fee plus an additional 10 percentage points above and beyond what I was already paying previously.
Yeah,
so essentially, if I'm reading this right, if it was anything under, I think you said, 300,000, didn't apply it.
Not paying any
So essentially what it's done is it's converted, I guess, a lot of properties to either pay the $500 as a flat fee or a flat surcharge, or $975.
Most properties are going to be the $975. I mean, you're talking about, $100,000 to $300,000, even an apartment.
Yeah, so that number, that's my point there, right? So that number there, essentially what the government have done with this policy is they've levied a tax essentially that didn't exist before for landholders of, call it $975 if you assume that most land components are valued between $100,000 and $300,000.
Yeah. Well, we'll run through some examples. I mean, run through an example of, sort of what it was like 2023 versus 2024. And this is 1 year's difference, right? So take us through some examples about what that looks like, Bills.
So if we're talking 2023 on $250,000 land value, you would pay 0% in land tax.
$0.
$0 in land tax. The changes come into effect 1st of January 2024. That same land value component, so it's valued at $250,000, you are now paying $975.
Yeah.
Where previously you were paying $0.
Yeah. And then you go, 500,000?
Yeah, so 500,000 in 2023, we were talking $975. In 2024, so once again, $775. I'm getting my numbers mixed up here because there's so many numbers written down. In 2024, $500,000 land value is $1,950.
So an extra, say, circa $1,200.
We're looking at almost a tripling.
Yeah.
And then on $1 million in 2023, you're talking $2,975 as the land tax value. 2024 rolls around, we're talking $4,650. So we're talking significant numbers from essentially 1 year to the next.
Yeah. I mean, you're talking about some significant cash flow pressure that you're putting onto, investment property owners.
Look, I'm looking at these numbers now, and if I owned a property and all of a sudden our land tax increased by that, the default position for me, straight to the managing agent, at least that increase on top, just like that.
Yeah.
So you're levying that tax on almost a part of the economy that is probably struggling the most in terms of cost of living pressure because they're bearing the brunt of the rental crisis as well too.
Yeah, exactly right. So it's definitely making things a lot more difficult out there for people that are holding an investment property. And the other thing that we're also not including within this is the land tax that you're going to be paying based off owning a property individually. If there's a trust involved, all of a sudden the land tax is significantly higher. Now, yes, there's a certain number of, or a certain element of the population that's going to own property through a trust. The vast majority, I'm assuming, and this is an assumption, so not backed by any statistics other than experience, but the vast majority of properties that are owned through a trust are going to be held through a self-managed super fund. So if you're holding property then through a self-managed super fund, and you're then looking at, someone that isn't particularly someone that, has an abundance of money, that, has enough money to purchase an investment property. And so, some of the rhetoric out there, which I 100% disagree with, is you've got the money, you've got an investment property, so you should, cough up and pay the burden. But people that own a property through a self-managed super fund are basically have converted an asset from one particular asset to another asset.
Yeah.
Doesn't necessarily mean that, they've got the money or they're the rich, so to speak. You're getting hit even harder from a cost perspective in order to be able to hold and manage that asset over the long term as well.
Yeah, well, actually, Andrew, that's a really good conduit into sort of where does this go and what impact does it have on the property market? Because thinking about that as a, landlord, like I was saying last time, if you're in a position where you can pass these costs on, now, 2 minutes ago, I just basically said, yes, that's what I'm going to do. Assuming that you can get that done and get that across the line, that's fine. You just kick the can down the road and basically make it someone else's problem. But in reality, if we're going through a period of time where we're increasing, rents to cover additional costs, cost of living, we're all feeling at higher interest rates. What happens if we get to a stage where we can't do that? Do I look at it as a investor and then say, you know what, this is just too hard. I'm not being rewarded for the risk that I'm taking.
Yeah.
The financial reward's not there. There's too many headaches. Can't trust the government anymore. Because in a short period of time, they keep breaking their promises and they keep making stupid policy decisions and all of that stuff. But where does it go, right? Like, just turn around and say, no, can't be bothered, sell it, make it someone else's problem.
Look, there's no doubt that this will have an impact on the investment property market. So that doesn't necessarily mean, and so when you say that statement, most people think, great, time to sell investment properties, market's going to crash. That's not what I'm saying. The market may still continue to go up, but it will have an impact. Yeah. And so it's either, and what that impact is, I think it's incredibly difficult and no one ultimately knows where it's going to land. But even if the property market, shoots up 5%, well, maybe it would have gone to 7% had it not been for the introduction of this. Or if the property market goes backwards 2%, well, maybe it would have stayed even if it, wasn't for this impact. But there's no doubt that this is going to have some sort of an impact on people that, hold an investment property, and then people that are looking at that on a decision perspective as to whether you enter that market. Because you and I have experienced it, significantly over the last 12 months, and this is yet another barrier for, whether you go down the investment property route or whether you look at other alternative assets.
Yeah, no, well said. I mean, look, it gets even worse and more complex when you think about it in a really simplistic sense. So you've got an investment property that you rent out that is sitting on some land. So there's an impact here in terms of the land tax that we're talking about. Over time, maybe you use some of that surplus to, whatever, accelerate your repayments, whatever it may be. You hold that property for 10 years, you've got some money left over, you probably need to do some renovations at some point in time, which we'll talk about building costs and the cost associated with that and tradespeople and the like. But you need to get some of that money. So it's not as rosy as it looks like. You need to get some of that money in order to meet that renovation, maintenance requirement, whatever it is. So then you can continue offering housing to people. This is just chipping away at what you've got available in order to reinvest back into it to make it fit for purpose for people to live in.
Yeah.
At the same time, interest rates have gone up. At the same time, building costs have gone up. So, you need to get your house painted 2 years ago versus what you're needing to get it painted for today. It's probably gone up by, insert number here.
Yeah.
It's a really interesting conundrum to see where this is going to go and how this is going to play out with investors. Because if it gets too hard, people are just going to say stuff it and, become less caring about their tenants and just say, push it through. I don't care of the impact and it's someone else's problem. Or we might see people, deciding to sell because they've had enough.
Yeah, definitely making things more challenging. And unfortunately, here at the 360 Money Matters podcast, we're not making the decisions. All we're doing is commenting on them and giving our very opinionated, I was going to say opinions on them, but that's...
Political statements.
Yeah, exactly.
No, but the good thing is, from our perspective, I mean, look, these are real challenges that people are facing. That's not the good thing. The good thing is that we're here to offer support and advice and guidance through these decisions. So it's not necessarily, it may be an emotional impact that this has had, but we do deliver rational and non-emotional decisions to try and maximise somebody's financial outcome if they're looking at making a decision.
And I think it really highlights the importance of having a plan, having a strategy, and having a buffer. Because if you think about the environment that, or what the environment was like, 24 months ago, you're purchasing an investment property. And for a lot of people, it's going to be cash flow positive. All I need to do is cough up a deposit. The tenants are going to pay off the property on its own. The costs of maintaining the property are not going to be all that much. And so you didn't need necessarily a buffer at that point in time. And so when you were having those conversations, people weren't resonating with it and didn't necessarily understand the importance of being conservative and understanding that there are certain points in time where things will become more difficult, and this just further highlights that.
Bring back the 2.5% interest rates when it was easy.
Exactly right. Exactly right.
Andrew, look, hopefully we've given our viewers and our listeners a bit of a deeper dive into sort of what we're looking at. Have we covered off everything that we wanted to hit up? Yeah. We want to have another dig at another politicians or something like that.
Yeah, exactly right. Maybe we should have one on the podcast just to, give another viewpoint and give them an answer or give them an opportunity to answer back. So
I'd stick it to the Prime Minister, but this is a state tax, so it's got nothing to do with the Prime Minister anyway. So we can blame Daniel Andrews for the mess that he put us in.
Yeah.
And now I don't know where he's on a beach getting his pension somewhere, so smarter than all of us, right? Andrew, thanks for another episode of the 360 Money Matters podcast.
Look forward to catching you on the next one. And thanks to all of our listeners, our viewers. And if you got some value out of this one, please like, subscribe, and we'll see you in a week.
Cheers. Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amiridis and Andrew Nicolaou of 360 Financial Strategists Pty Ltd, authorized representatives and credit representatives of AMP Financial Planning.